Hello and welcome to Earnings Echo. We put together the most important information about Snowflake Inc. Imagine a company priced for, well, absolute perfection, where, anything less than 20% growth over the next decade is basically considered a failure.
Right, which is a massive hurdle.
Exactly. So today we are looking at Snowflake's Q1 fiscal 2027 results. And for you, the investor, the mission is simple. We are stripping away the noise to figure out if this massive AI boom is actually real or if a major market correction is looming for the stock.
Yeah, so let's get straight to the numbers. Product revenue hit $1.334 billion. So that is a 34% year-over-year growth.
Wow, 34%.
I know, it's a major acceleration from recent quarters. Plus, their non-GAAP operating margin expanded to 11.9%.
Okay, that is pretty solid.
Definitely. And management confidently raised the full-year product revenue guidance to $5.84 billion, which implies 31% year-over-year growth.
I mean, the market clearly loved that, right? The stock popped straight to $175.26. But wait, looking at the timeline, Snowflake made their new AI tool Cortex code generally available back in February.
They did, yeah.
So my question is this 34% growth a genuine, durable acceleration of their core business? Or are we just looking at, like, a temporary sugar rush driven by the immediate launch of Cortex code?
Well, the underlying metrics point to something much more structural than just a quick spike.
Yeah.
Take their net revenue retention. It is sitting highly resilient at 126%.
Okay, so in plain English, their existing customers are spending 26% more this year than they did last year.
Right. They are not just staying on the platform, they are expanding. And the heavy lifting is being done by massive enterprises. They now have 779 customers spending over $1 million annually, which is up 29% year over year.
Hold on, let me play devil's advocate for a second. Management is heavily promoting this idea of the agentic enterprise and, their flashy new AI tools like Snowflake Intelligence.
Yeah, it is a huge part of their messaging.
But are these specific new products actually moving the revenue needle yet? Or is this just standard, boring enterprise data migration to the cloud, just dressed up in an AI tuxedo?
That is exactly where the earnings call got really fascinating. This CEO explicitly called Q1 an inflection point.
Which, I mean, is a favorite tech buzzword.
Oh, absolutely.
Yeah.
But he backed it up with the mechanics of why it is happening. AI models are essentially useless without clean, organized data. So to use tools like Cortex, these giant corporations are being forced to dump massive amounts of their fragmented, messy data into Snowflake first.
Oh, I see. So the core data migration is what is driving the revenue, but the urgent need to use AI is what is forcing that migration to happen right now.
Exactly. Though it is worth noting they did acquire Observe recently, but is progressing slowly and contributed less than 1% to growth. The real focus was a CFO confidently raising that full-year product revenue guide from 27% to 31%.
Okay, that makes sense. But is management's narrative about an endless flywheel effect a bit premature? We are still operating in a macro environment where, enterprise IT budgets are scrutinized to the penny.
Yeah, budgets are definitely tightening.
So if macro conditions are tough, how on earth is the market justifying a $175 stock price?
Well, to understand that price tag, we have to look at a reverse discounted cash flow model. Think of a reverse DCF, like looking at the final score of a baseball game and mathematically reverse engineering every single inning to see exactly how they got there.
Right. So it is not an exact science.
No, not at all, but it acts as a diagnostic tool. By taking that $175 stock price, we can work backward to see what growth the market is pricing in. Right now, the market implies Snowflake will grow its free cash flow by roughly 20% every single year for the next 10 years.
Wow. I mean, growing cash flow by 20% annually for a decade is an incredibly high hurdle. And the primary threat to that trajectory is Databricks, right?
Oh, without a doubt.
Because Databricks is a $134 billion private competitor, maintaining 20% growth with a looming Databricks IPO threatening to disrupt market share and pricing. That just seems like a highly optimistic baseline.
Yeah, that is the core tension here. The long-term thesis forming is that Snowflake is successfully transitioning AI from a conceptual buzzword into a tangible, measurable revenue driver.
Right. They are proving that enterprise adoption is actually real.
Exactly.
Which brings us to the final echo for you to take away today. If you are looking at Snowflake, here is what you actually need to watch. The company is executing flawlessly right now, pairing re-accelerating top-line growth with expanding margins.
But at this valuation, perfection is totally priced in.
Yeah, any future slowdown in AI adoption will be heavily penalized. So consider this as you review your portfolios. As open source AI models become increasingly powerful and accessible, will the premium paid for proprietary data ecosystems like Snowflake's hold up? Or will that structural moat eventually begin to commoditize?
That is the big question to watch.
And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked. Portfolio prepped. Catch you again soon.